In this week's market update, geopolitics and football will dominate the headlines this week, but a string of central bank meetings is likely to be more important for markets. It's a thin week for corporate news. For a president who likes to be in the spotlight, this is quite a week for Donald Trump. From the G7 summit in Canada to the unprecedented US-North Korea meeting in Singapore, all eyes are on an increasingly unpredictable US president. Expectations were extremely low for the gathering of the leading industrial nations in Canada over the weekend, but even with the bar set so low, the G7 summit managed to undershoot. The feeling that the G7 is now the G6 plus one is now unavoidable. That's because Donald Trump has chosen to turn his back on America's allies in a dramatic escalation of the unfolding trade war. The main target for the US in that conflict should be China, a country with which the US has a massive trade deficit. However, it's currently America's friends in Europe and Canada who seem to be getting caught in the crossfire. Trade was the principal topic of discussion at the G7 meeting, where the US's allies made it clear that the imposition of tariffs on steel and aluminium were unacceptable. Donald Trump's response was, as usual, a volley of angry tweets, compounded this time by an early departure on Air Force One to prepare for a meeting that Trump considers much more important with Kim Jong-un, the North Korean leader. In a spectacular show of pique for a US president, Trump retracted his support for a joint G7 communique after he'd departed. The withdrawal of support seemed to be a petulant reaction to a press conference in which Canadian Prime Minister Justin Trudeau had described the metals tariffs as insulting. The president had already caused bad feeling among the G7 members by calling for the reinstatement of Russia into what was, until 2014, the G8. Russia was expelled from that group following his illegal annexation of Crimea. The communique had been a pretty bland affair, calling for a continuation of the rules-based international trading system that America has supported and been central to since the Second World War. But even that was too much for the US president, who has now embarked on an isolationist, protectionist approach to global relations. Attention has quickly shifted, however, to today's meeting with North Korea's leader, Kim Jong-un, in Singapore, on which Trump appears to be staking his reputation as a statesman. The goal of the summit for the US president is the denuclearization of the Korean peninsula and a shift in the balance of power in the region back from China to the US again. The early signs are that the two sides have made significant strides towards a deal, with both signing a letter committing to a new relationship that puts the bitter animosity between the two countries behind them. The market response has been positive, with the dollar stronger and yen weaker as investors embrace risk again. Stock markets in Asia were the first to pick up on the Korean developments, with the good news spilling over into Europe. What is not clear is the extent to which the US is in the driving seat in the talks or is being exploited by North Korea, which is desperate to have sanctions lifted, or indeed by China, which remains the key influence over its neighbour and is determined to retain a buffer between itself and US-supported South Korea. It's a high-stakes game being played by the president, with no experience in global diplomacy but a rock-solid belief in his ability to strike a deal. The G7 and the Singapore summit are providing the headlines and are important for market sentiment. But for investors, the more important events are in the central banks of America, Europe and Japan this week. The Federal Reserve meeting, which concludes on Wednesday, is almost certain to see interest rates in the US hiked once more by a quarter percentage point to between 1.75% and 2%. The real question for the US central bank is the pace of tightening from here, whether there'll be just one more hike in 2018 or another two. Recent data have pointed to renewed strength in the US economy, but trade war fears continue to cast a shadow. The Fed will be keeping an eye on a flurry of data this week, including inflation numbers, retail sales, and consumer sentiment. Also watching the Fed closely this week will be the finance ministers of many emerging market economies, where rising US interest rates are a concern thanks to their impact on the level of the dollar. Higher US interest rates and a rising US currency are typically bad news for emerging markets because they encourage capital flows back to America from riskier markets, and because they tighten financial conditions, making it more expensive to finance dollar-denominated debts. This week, the pressure on a key emerging market, Argentina, eased as the IMF offered the country a $50 billion loan facility, much more than expected. Elsewhere, Turkey raised interest rates, despite President Erdogan's resistance to doing so, in a bid to protect the falling lira. Attention is also focused on Brazil, where the political situation is tense ahead of autumn elections, and on South Africa, which saw GDP fall by the most in a decade in the first quarter. Probably of more interest than the Fed is the commentary around the ECB's meeting on Thursday in Riga, which will probably leave interest rates on hold, but which is also expected to shine some light on the European Central Bank's plans to end bond purchases from September. The end of QE in Europe is seen as the first step in Europe's emergence from the financial crisis and a precursor to interest rates finally being returned to positive territory sometime next year. The ECB would have been relieved by the rally early this week in Italian assets, as the country's new finance minister made reassuring noises about Italy's future in the Eurozone. He said, "We're not discussing any proposal to exit the euro," and that pushed the MIB equity index 2.3% higher and knocked 26 basis points, 0.25%, off the 10-year government bond yield as buyers returned. Also announcing a rates decision this week is the Bank of Japan, although here the central bank remains committed to an ultra-loose policy, with the struggle to lift the economy out of its generation-long economic slump still not won. Indeed, with GDP growth falling into negative territory in the first quarter for the first time in 2 years, tightening still seems a long way off. The UK's Bank of England is the only major central bank not meeting this week, but there's no shortage of data for rate setters to focus on. Already this week, we've seen the pound fall back on construction and manufacturing output numbers that were described by one economist as miserable. The figures suggested that the recovery from the cold, snowy weather in February and March may be long and shallow. Sterling slipped to under $1.34 on the news. Still to come this week, we have wage data and inflation figures. These will shine the spotlight on whether or not an August rate hike is on the cards, the next likely date for a quarter-point rise. One of the key contributors to Britain's sluggish economy at the moment will also be in focus this week, as Parliament votes on a number of key amendments to the EU withdrawal bill, which were passed by the House of Lords and come up for debate in the Commons this week. Supporting the amendments could be a body blow for the Prime Minister, because it would suggest that she will struggle to get a Brexit deal approved for Parliament when it comes up for a vote in the autumn. However, resistance to the government remains uncoordinated, with Labour as divided as the Tories on the EU. And Remain supporters are thought to be nervous about putting the knife into the PM and running the risk of her successor being something worse, namely a hard Brexiteer like Boris Johnson or a Labour government under Jeremy Corbyn. The key amendments to watch out for are those related to Britain's future membership of a customs union, a separate one related to Britain remaining in the European Economic Area, that's the so-called Norway option, which effectively keeps us close to or in the single market, and one on the so-called meaningful vote on the Brexit deal, which is designed to give Parliament more of a say in what happens next, including the possibility of calling a second referendum. Finally, on the corporate front, it's relatively quiet this week, with a few key announcements to keep an eye on. Inditex, the owner of Zara and the world's largest clothes retailer, is due to announce first quarter figures. Attention will be on the company's margins, which have been under pressure for several years as online retailers continue to squeeze traditional bricks and mortar shops. In the UK, Majestic Wine will update on its full-year figures on Thursday. It will be hoping that the World Cup, which starts that day in Russia, will give sales a boost as we all settle on the sofa for a month of football. Also likely to be a beneficiary would be Tesco, which has a trading announcement on Friday. Full-year figures in April were viewed as a comeback for the supermarket chain, which has been through the ringer in recent years thanks to an accounting scandal and heightened competition in the UK grocery market.